Markets are up some 8% since we last spoke in March, but we're still very positive on the outlook for European markets. As I think we've said many times before, companies are able to generate much better, much higher earnings than the market expects. And there are two really very strong drivers. The first, I think, is beginning to become reasonably well understood, is how quickly and aggressively companies cut costs as the crisis emerged. And certainly in the years I've done this job, I've never seen such a quick and aggressive reaction. And the second point, which we think has not been fully appreciated yet, is how strong demand remains in the emerging world, and how quickly the recovery is spreading to the West. And we can see this in the United States in particular, but also very strong signs of recovery in Europe. And at our company meetings we've had over the past few months, we've seen this. Also, if you look at the more general economists and business type surveys, they show rapidly recovering confidence across Europe. Despite the uncertainty at the moment over the Greek finances and the possible risks of contagion to Portugal and Italy and Spain, we still think overall the macroeconomic environment is pretty supportive. Credit, as you know, has become much more available again, particularly for larger companies. Interest rates remain at breathtakingly low levels at the moment, and if you're able to borrow money, it's the most fantastic time to be able to buy assets. And also we have the various stimulus plans across the world. The benefits now beginning to come quite strongly through to companies. I think another positive we find is how cautious many investors are. We're surprised, most of our old clients and friends we've known for many years, by how little invested they are in equities. And at probably the most extreme level, insurance companies now in many cases have less than 1% equity exposure, which is certainly as low as it's been since I've done this job. And then finally, on the positive side, valuations still look to us pretty reasonable. The market's gone up a lot, but again earnings have risen in line with that. So we're still trading on about 11 times, which is a little bit below the long-term average. I think, as I said before, European markets are now they're certainly much cheaper than the US market, and some 40%. And we think this is unjustified because the quality of European company earnings is now every bit as good as their American counterparts. And of course, the final point on valuation, as I think we've noted many times before again, shares appear very cheap compared to bonds and certainly against cash. I suppose the main risk, the sort of unknown risk, is the possible impacts of the reversal of quantitative easing, and what sort of impact on the economy there will be when governments start to deleverage. We think these are potential risks much further out, perhaps a year or so, and we think that they've probably in many cases been exaggerated. If you go into the past, you can see that countries have managed strong economic growth even against a background of rising government debt. Looking at the overall shape of our European funds at the moment, still we predominantly in cyclical and financial shares, about 2/3 of our portfolios. In the cyclical side, we have a broad range of different opportunities, from Accor in the hotel side to Fiat in automobiles, ASML in lithography and ITV. Our financials, again, a broad base. We focused on a number of the retail banks in Europe, like Crédit Agricole, KBC, and even Lloyds Bank in the UK. And we think there's a great opportunity from UBS restructuring. Aside from that, we still have a large chunk of the funds exposed to growth type companies such as LVMH or SGS and Experian. Thank you.